When Europe's largest bank triggers emergency protocols that haven't been activated since the 2008 financial crisis, the silence that follows is more terrifying than the chaos that preceded it. January 22nd, 2026. 2:47 a.m. Central European Time. Deutsche Bank's executive board convened an emergency session that would conclude with the invocation of Article 48 of the European Banking Union Emergency Framework, a legal mechanism designed for existential threats to continental financial stability. The crisis began not with market panic or external shock, but with a routine internal audit that uncovered what Deutsche Bank's chief risk officer would later describe as systematic mathematical impossibilities in the bank's derivative portfolio. Within 18 hours, the German Federal Financial Supervisory Authority had been notified. Within 36 hours, the European Central Bank had activated crisis protocols. Within 72 hours, $340 billion worth of interconnected European banking exposures faced potential simultaneous default. The trigger was not a single transaction or isolated incident. It was the discovery that Deutsche Bank's derivative trading algorithms had been systematically misreporting counterparty risk for an estimated 47 months, creating phantom liquidity that supported approximately $312 billion in leveraged positions across 17 European financial institutions. When the algorithms were corrected, the bank's actual capital position revealed a deficit that threatened not just Deutsche Bank's survival, but the stability of the entire European banking ecosystem. The mathematical error that triggered the crisis had its origins in a software update implemented in March 2022, during the height of the Russia-Ukraine conflict when market volatility required rapid system adjustments. The update, designed to enhance real-time risk calculation, contained a coding error that systematically understated correlation risk between sovereign debt and currency derivatives by an average of 23%. For 47 months, the error compounded. Every derivative trade based on the miscalculated risk parameters increased Deutsche Bank's actual exposure while maintaining the illusion of regulatory compliance. The bank's risk management systems showed capital ratios comfortably above Basel III requirements. The reality was a leverage position that exceeded the bank's total capital base by a factor of 4.7. The discovery occurred during a routine stress test preparation when junior analysts noticed discrepancies between manual calculations and automated risk reports. Initial investigations suggested data entry errors. Deeper analysis revealed systematic algorithmic failure. Final audit confirmed that Deutsche Bank had unknowingly operated as an effectively bankrupt institution for nearly 4 years, while reporting record profits to shareholders and regulators. The European Central Bank's emergency response was swift but carefully orchestrated to prevent panic. Public statements referenced technical adjustments to risk management protocols and enhanced supervisory coordination. No specific institution was named, no crisis terminology was used. The language was designed to signal control rather than alarm, competence rather than catastrophe. But the silence concealed frantic coordination between central banks, treasury ministries, and banking supervisors across the European Union. Conference calls convened hourly. Emergency powers were quietly activated. Contingency plans were dusted off and updated. The absence of public alarm masked the presence of institutional terror. The timing could not have been worse. European banks were already stressed by persistent inflation, energy crisis, after effects, and geopolitical uncertainty. Deutsche Bank's revelation meant that stress test scenarios had been based on fundamentally flawed assumptions about systemic risk. If one major bank could operate unknowingly bankrupt for 4 years, how many other institutions faced similar hidden vulnerabilities? Deutsche Bank's derivative portfolio was not isolated, but interconnected with European financial institutions through a complex web of swaps, credit default swaps, and structured products. The bank's miscalculated risk positions had been sold to counterparties including BNP Paribas, Société Générale, UniCredit, and Santander. When Deutsche Bank's true risk exposure was revealed, these institutions faced immediate revaluation of positions worth hundreds of billions. The European Banking Authority initiated emergency reviews of 17 institutions with significant Deutsche Bank exposure. Preliminary analysis suggested that 5 banks faced potential capital shortfalls exceeding $50 billion. 3 institutions showed leverage ratios that fell below regulatory minimums when Deutsche Bank correlations were properly calculated. The systemic risk was not limited to one bank, but distributed throughout the European banking network. Credit markets began repricing European bank debt within hours of the Article 48 activation. Deutsche Bank's credit default swaps widened by 340 basis points before trading was suspended. BNP Paribas and UniCredit experienced similar volatility as investors recognized that the crisis extended beyond a single institution. European bank equity indices fell 8.7% before market circuit breakers activated. Monetary policy crisis? The European Central Bank faced an impossible choice between maintaining price stability and preventing financial system collapse. Supporting Deutsche Bank and its counterparties would require massive liquidity injection that could reignite inflation just as price pressures were stabilizing. Allowing bank failures would trigger deflation and economic contraction that could fragment the Eurozone. Emergency monetary policy meetings convened in Frankfurt as ECB governors weighed options that range from targeted bank recapitalization to full activation of emergency lending facilities. Each option carried severe consequences. Direct bank support would require parliamentary approval in multiple member states. Emergency lending would signal crisis severity that could trigger broader panic. The crisis also exposed the limitations of European monetary union when fiscal support required national government action. German taxpayers faced potential liability for Deutsche Bank losses. French citizens could be forced to support BNP Paribas recapitalization. Italian voters might reject Unicredit bailouts. The banking crisis threatened to become a political crisis that undermined European integration. Regulatory failure. The Deutsche Bank revelation exposed catastrophic failures in European banking supervision that extended beyond single institution oversight to systemic risk management. Banking union was designed to prevent exactly this type of hidden systemic vulnerability. The failure meant that regulatory frameworks established after 2008 were insufficient for modern financial complexity. European banking supervision had been conducted on the basis of bank-reported data that proved systematically false. Stress tests had been passed using calculations that fundamentally misrepresented actual risk. Capital requirements had been met through accounting that masked rather than revealed true exposures. The entire regulatory edifice was built on foundations that had been compromised for years. The crisis demanded immediate regulatory response, but also revealed that traditional supervision was inadequate for algorithmic trading systems and complex derivative networks. Banks were using mathematical models that regulators could not audit and risk management systems that operated beyond supervisory comprehension. The failure was not just procedural, but technological and institutional, geopolitical vulnerability. The banking crisis occurred precisely when European financial stability was already strained by geopolitical tensions and energy transition costs. European governments faced simultaneous pressure to support Ukraine, manage inflation, fund green energy infrastructure, and now rescue systemically important banks. The fiscal burden threatened to exceed political capacity in multiple member states. Foreign adversaries would certainly exploit European banking weakness to advance strategic objectives. Russian intelligence had already demonstrated capability to manipulate Western financial markets through cyber attacks and information warfare. Chinese economic influence could expand if European banks required emergency capital that only Asian investors could provide. The banking crisis had national security implications that extended far beyond financial stability. The point of irreversible transformation arrived at 3:17 p.m. Brussels time on January 25th. The Article 107.3b, activation authorized $750 billion in emergency bank capitalization across the European Union, distributed according to exposure calculations that would be determined by the European Central Bank rather than market mechanisms. The decision represented the end of market-based banking in Europe and the beginning of permanent state control over financial institution capital allocation. But the truly irreversible change was institutional rather than financial. The crisis had demonstrated that European banking union was structurally incapable of managing systemic risk in modern financial markets. Regulatory frameworks based on national supervision and market discipline could not address algorithmic failures and computational complexity that operated beyond human oversight capability. European leaders privately acknowledged that banking union as conceived was politically and technically obsolete. Future financial stability would require either complete fiscal federalization with shared liability for all bank losses, or fragmentation back to national banking systems with limited cross-border integration. The middle ground of coordinated supervision without shared responsibility had proven impossible to maintain under stress. The crisis also marked the end of European financial autonomy. Emergency bank capitalization would require resources beyond European fiscal capacity, forcing reliance on international financial institutions and foreign central bank cooperation. The Federal Reserve, Bank of Japan, and potentially the People's Bank of China would become stakeholders in European banking stability, with influence over European monetary policy that market mechanisms alone could not provide. European banking had become too big to fail, but too complex to manage and too expensive to save. The mathematical logic was inescapable. Financial systems that operated beyond regulatory comprehension could not maintain democratic legitimacy. Either technology would be subordinated to political control, or political control would be subordinated to technological complexity. 6 weeks after the Article 48 activation, European banks operated under emergency supervision that had become the new normal. Deutsche Bank's derivative positions were gradually unwound under ECB guidance, but the process was expected to take 18 months and require continuous central bank support. The immediate crisis had stabilized, but the underlying vulnerabilities remained unresolved and potentially unresolvable. The crisis had revealed something more fundamental than regulatory failure or risk management breakdown. It had exposed the impossibility of democratic control over financial systems that operated through algorithmic complexity beyond human comprehension. European banks had become autonomous systems that could threaten their host economies without human knowledge or intention. The response was institutional rather than merely financial. European banking was being restructured around political control rather than market efficiency. Algorithm oversight, mandatory transparency, and simplified product restrictions were replacing the complex risk management that had enabled the crisis. The result would be less efficient, but more politically accountable financial institutions. But the changes came too late to prevent broader consequences. The banking crisis had accelerated European economic divergence as member states pursued different strategies for financial stability. Germany emphasized fiscal discipline and bank resolution. France supported active state intervention and industrial policy. Italy demanded European fiscal transfers and debt mutualization. The banking union that was supposed to create convergence was instead producing fragmentation. International financial markets had fundamentally repriced European systemic risk. European bank debt traded at permanent premiums that reflected political rather than economic fundamentals. Foreign investment in European financial institutions required government guarantees rather than market returns. The European financial system had become a ward of state support rather than an engine of economic growth. The Deutsche Bank crisis was not an isolated event, but a symptom of broader transformation in the relationship between finance, technology, and political authority. Democratic governments were discovering that financial systems had evolved beyond their capacity for oversight or control. The choice was increasingly between technological efficiency and political legitimacy, between market complexity and democratic accountability. The crisis that began with a coding error had become a constitutional question about the compatibility of algorithmic finance with democratic governance. European leaders were quietly acknowledging that financial technology might require political constraints that would sacrifice economic efficiency for institutional stability. The era of unlimited financial innovation was ending, replaced by systems designed for political control rather than mathematical optimization. The silence that had characterized the initial crisis response had given way to controlled management of permanent change. European banking would never return to the complexity and autonomy that had enabled the crisis, but neither would it return to the efficiency and innovation that had characterized its previous success. The transformation was irreversible, necessary, and profoundly uncertain in its ultimate consequences. In the end, the Deutsche Bank crisis represented more than financial emergency. It marked the moment when European societies chose political control over technological efficiency, democratic accountability over algorithmic optimization. Whether this choice would prove wise or disastrous would depend on developments that remained beyond prediction or control, but the choice itself had become irreversible. If you found this analysis valuable, subscribe to stay ahead of the financial crisis developments. The mainstream media won't show you until it's too late.